Hi, my name's Leon Rowe, currency trader and trading coach at trading180.com, and welcome to this week's supply and demand Forex Gold and S&P fundamental and technical analysis for the week ahead starting the 22nd of March. Hope you all had a great trading week. And if you like the videos I provide every weekend, please don't forget to like, subscribe, and share this video with your fellow trading colleagues. So getting into the week ahead according to Trading economics. Investors will closely monitor speeches by several Federal Reserve officials in the United States, along with key economic data releases such as personal income and spending, PCE price indices, and S&P global PMIs, CB consumer confidence, durable goods orders, and the final reading of Q4 GDP growth. Globally, March PMIs will be released for Japan, France, Germany, the Euro area, and the UK. Inflation data will be reported for Australia, the UK, and France. Meanwhile, Germany's unemployment rate and IFO business climate, Canada's February growth estimate, and the UK's goods trade balance will also be closely watched. So, lots going on this week. Now, just to give you an overall on really what's happening with, I guess, the fundamental side of things. And I guess, yeah, we start off on the US dollar, but I've been getting quite a few questions regarding, fundamentals and what's going on and what's happening. And it's a difficult time, really, for everybody, right? Even the central banks. So it says here central bankers move slowly through the fog of Trump's trade wars. So we're really in quite uncertain times. And I guess this will give you an idea of how cautious central banks are, and not even just central banks, really, the market is in terms of, trying to understand the impact of Trump's tariffs. Therefore, understanding what the central banks may do with interest rates, because of course tariffs will affect not just the U.S. economy but economies around the world, as well as inflation as well. So, but no one knows to what degree. But the thought is that it should end up making inflation go a little bit higher. So, US President Donald Trump has already upended global trade and the post war international security consensus. Now he's throwing central banking into disarray. Monetary policymakers are being knocked off course by the twists and turns of White House policy, with markets paring back interest rate cut expectations across the globe. No longer are central bankers either the frontmen or rhythm keepers of macro policies, says Thierry Wisman, a strategist at Macquarie. I think that's how you pronounce it. Um, they're now followers who are ceding their dynamism to events in federal legislatures, executive mansions, and diplomatic halls. It is incredibly difficult to say where interest rates are going to move, says European Central Bank Governing Council member Klaas Knot. He cited the difficulty of predicting whether Eurozone inflation moves up or down as a result of tariffs and retaliatory measures, along with a ramp up in spending on infrastructure and defense across the bloc. For the moment, the safest path for central banks is to put policies on ice. The murkier the future has become, the more it pays to wait and see. And so, we're in this scenario where it's very uncertain. We don't know how countries are going to react to the tariffs, whether they'll, cede to Donald Trump's, reciprocal tariffs, or whether they'll escalate, right? So at the moment, central banks are watching, the market is watching and positioning. And so as us, lowly retail traders, we have to kind of do the same, right? Let's not be so arrogant as to think that we can know what's going on at all times. And a lot of times when we don't know what's going on, right, the best thing to do is to sit on our hands until the dust settles and it clears and things kind of get back to maybe some sort of normality, or where there's a trading opportunity. And there have been trading opportunities still, if the right pairs to trade. But the typical pairs and the usual pairs that traders usually trade, like the pound, the dollar, the euro, have been a bit on the trickier side, right? But here is some rate forecasts and what the market is pricing in. This was from Thursday's data, which is still quite relevant. And the Fed, it looks like, are pricing in, or the market is pricing in, at least 68 basis points of cuts, but there's a 79% probability of no change at the upcoming meeting. The ECB quite low when it comes to interest rate cuts, 49 basis points of cuts priced in, being priced in by the year end, with a 60% probability of a rate cut in the upcoming meeting. Bank of England, 53 basis points being priced in, 96% probability of no change at today's decision, and so on and so forth, right? But if you notice, we have no change for the Fed, no change for the Bank of Canada, no change for the RBA, no change for the RBNZ, um, no change for the SMB, and quite high probabilities. And then we've got no change for the Bank of Japan, and they're really the only central bank that are hiking out of the major central banks. Now, there is a 64% probability of a rate cut at the upcoming meeting for the RBNZ, and at the moment 60%. And this is, of course, subject to change depending on the data, but you can see how the majority of central banks are looking at, you know, the market is probably thinking that they're not really going to begin cutting or continue cutting until the April reciprocal tariffs start to really take effect. So again, tricky times at the moment, but there are opportunities, and we got into, actually, this week was quite a profitable week for a lot of traders in the group, and I'll share some of those trades with you guys at the end of the video. So going into this week for me, I think the US dollar, and this is the US dollar equally weighted index, I do think that the dollar could still be a buy now, although the Fed was seen as being quite dovish at the FOMC meeting. It says here the Federal Reserve officials held their benchmark interest rate steady for a second straight meeting, caught between mounting concerns that the economy is slowing and inflation could remain stubbornly high. And that really is what stagflation is, where you have a cooling economy, a contracting economy potentially, and inflation is, a bit too high. So it says here, Chair Jerome Powell acknowledged the high degree of uncertainty from President Donald Trump's significant policy changes, but repeated the central bank is not in a hurry to adjust borrowing costs. He said officials can wait for a greater clarity on the impact of those policies on the economy before acting. So that's the reason why you see that there's quite a high probability from the Fed that there's no change at the next meeting. And it says here, updated projections. It says the new economic projections showed the Fed officials marked down their forecasts for growth this year while boosting estimates of inflation. It also showed officials continue to pencil in a half percentage point of rate cuts this year, according to the median estimates, implying 2 quarter point rate reductions. Powell said the outlook for monetary policy didn't change because the forecasts for lower growth and higher inflation balance each other out. So the dollar, you can kind of look for, I think, buys and sells, but I think going into the reciprocal tariffs, I think the dollar and the US economy may be one of the economies actually better off. So that could actually drive the dollar a little bit higher. Now, I don't think that prices will go, back up to these highs again, but I can see there being a move. Now, I'm not saying that this is going to happen this week, but as we go into into April, we could see actually the dollar move to the upside. How it gets there, it could, pull back a little bit next week, and then move up, right? Could do something like that, or it could just literally just, do something like this, right, to the upside. Who knows? But I think that's probably what I would be leaning towards. So I do think that the dollar in a risk off environment should typically, historically, be a bit more of a buy. So I would be leaning towards more buying of the dollar over the next few weeks. Now, of course, if market sentiment continues to think that the tariffs will hurt the US economy more than it will hurt, for example, the European economy or the Canadian economy or China's economy, then of course the dollar would be likely be a sell. But for now, I'm thinking that the dollar is a bit more, slightly more of on the buy side. Although I totally understand why you would be looking for, sell trades too. Looking at the dollar yen, again, not really a pair that I'm interested in, but we did come up into this supply zone, a really nice supply zone with some extra confluence as well with regards to support and resistance. So, but again, for me, I think probably the yen maybe has the edge because it is hiking rates. So this could be looked at as a bit of a shorting opportunity, but I think there are better pairs to buy the yen against, right? So I would look for maybe a commodity currency. I say maybe, but I would look for commodity currencies if I'm looking to buy the Japanese yen. I wouldn't necessarily look for the US dollar. But if you are interested in taking, this pair as a short, then now is a decent time technically. Or if you're looking for buys, then you're looking for at least a pullback down into that zone, which it bounced off maybe a little bit higher around here. And if you're looking for, again, some extra support and resistance for confluence, then you definitely know that that area is decent for a potential buy. Looking at the dollar Swiss, again, the Swiss franc really called an end to their rate cutting cycle this week, which could be seen as quite hawkish. And so I think this pair, I was actually quite looking for long trades on this, but as the Swiss National Bank have kind of ended their cutting cycle for now, I think again there are probably better trades. Also, as well as risk off starts to ramp up as we get closer to April, I think the Swiss franc could actually be a buy over the next couple of weeks. But again, it really does depend upon um, risk sentiment. If you are looking for a short trade, meaning that you're going to be buying the Swiss franc against the dollar, then you're looking at that area there right now as a sell trade. And if you're looking for a buy trade, then I would probably wait for a fresher area of demand. If it goes just below this level, around below that 0.8756 area, before looking at going long. But I'm not really interested in trading this pair anymore. Dollar CAD is definitely an interesting pair and worth keeping. I think the dollar should have the edge, and if I'm right about the dollar, then of course we should see some higher highs being made. If you're not in this trade already and you're waiting for a buy or looking to buy, then really got to wait for a pullback before looking at going long. Again, in a risk off environment, I think the dollar should have the edge. Looking at the pound, and the pound ended up getting literally stopped out to the pip, meaning that it prices went up to where my stop loss was at 1.3014, right, and stopped me out the last of my two positions. I had already made one of the positions, but stopped me out. I'll get into that a bit later before reversing, right? If I literally had my stop just about a pip or two above that, I would have actually this overall trade would have been a more of a profitable trade. I won one position, lost two, so not too bad. Plus, as well, all three positions were really half of my normal positions. There just was a bit of a gamble trade. I'm really kind of thinking that the budget is going to cause the UK to kind of contract, right, in terms of the Chancellor's budget, the April budget, fiscal policies of the of the UK are not going to be good for the UK economy. And it says here that a bigger bank of England cutting cycle could unlock extra cash. Between now and the autumn, we think the Treasury will benefit from a repricing in Bank of England expectations. If we're right that it cuts rates further than the financial markets currently expect, that could gift Reeves with £2 to £3 billion in extra headroom, but a similar windfall from lower gilt yields is less likely given our house view that both the US and German yields rise through 2025. So ultimately, if ING are actually quite dovish on the Bank of England, so they're saying that in fact there should be more rate cuts priced in by the market. At the moment, it's currently 53 basis points, but if the economy does start to contract a bit, due to the fiscal policies of the government, then in fact the Bank of England will price in more cuts, which would then cause the Bank of England or the pound anyway, and cause the Bank of England to maybe cut more, which would then cause the pound to end up falling. And that's really what I was looking for. So I kind of, placed a smaller position than usual on that bet. Um, and I was, it would have been a profitable trade, but it is what it is. I'll look for probably try and get in again if prices do move up to this area here. But if you are looking for a sell trade, then you can kind of again look for where I'm looking at the 130 round number or near there if it pulls back, and then look for a short trade. If you are looking for long trades right now, then the bounce off of this demand zone is going to be the first opportunity to do so. Looking at the pound yen, and again in the group, many traders ended up getting involved in this short this week, which was up here. And many traders made a decent profit on this trade. I didn't get involved in this. I didn't think that I kind of was looking for the pound dollar rather than the pound yen. But either way, it worked out for the pound yen traders. That's fine. And yeah, so that was basically a profitable trading off the top of this supply zone. So where we're at now, in fact, I should move that up a little bit and then move that off, is again, I think I would rather be a buyer of the yen than the pound. And if this pulls back up to this area here, and again, kind of betting on the fiscal policy of the UK not being great for the UK, and actually to continue on with this article. So it says here, further tax rises look inevitable. So it says here, if the scope to cut public spending becomes more limited, the Treasury struggles to convince the OBR to upgrade its growth forecast, right? So that's the economy, and it is reticent to make further changes to its fiscal rules. Then that leaves one final option: raise taxes. Indeed, we think that's now inevitable in the autumn, and the only question is which taxes will end up rising. And if taxes rise, then of course that could contract the economy. Of course, much depends on how impactful the current rounds of tax hikes, which come through in April, are on the jobs market, and that is key, right? Jobs. We definitely want to keep an eye on the jobs market. So far, the evidence is mixed. Surveys point to much weaker hiring appetite, but so far the official employment data hasn't worsened. If that changes, then that might be what forces the government to rethink its aversion to lifting income tax or employee national insurance. So let's see what happens with the pound when it comes to selling off. I do think the pound is on the expensive side. I do think that going into April, if prices do pull back, this could actually be quite a nice area to look for some shorts, or just above that at the 195s. Looking at the euro dollar is pulling back. Actually, matter of fact, this is the euro index. Sorry. So the euro index This is again the equally weighted index, and this is the euro against the dollar, the pound, the yen, the CAD, the Australian dollar, the Swiss franc, and the New Zealand dollar, right? So this is overall yen strength, euro strength. So you can kind of see what the euro has been doing over the past couple of weeks. We pulled back down to this demand zone, so I do think that the euro is now more of a buy. In my book, there has been quite a few articles suggesting that the euro, institutions are looking at buying the euro. It says here Germany's 10-year bond yield rising to 4% is entirely feasible as a reset in the country's borrowing cost plays out, according to Aviva investors. Now, bond yields, German bond yields rising, or just treasury bond yields in general, are very sensitive to interest rates. And the rule of thumb is that when bond yields rise, that's the expectation that, in fact, interest rates are likely to go higher. And if bond yields fall, then interest rates are likely to come down. That doesn't mean that, that would play out on a daily basis or even on a weekly basis. Just because bond yields are down this week doesn't mean that, the market is pricing in rate cuts or pricing in rate hikes. It's over a period of time, but it's significant because, of course, if they're projecting bond yields to move another 100 basis points or 1% from where it is now, then of course that would definitely mean that uh, uh, the euro should appreciate. And in fact, I can't really do it now, but I should have went to bond yields and kind of showed you guys. But maybe I'll do it another time in the next week. But ultimately, that's what this is saying, right? And it says here that Vasilios Gikionikis, I think that's how you pronounce his name, um, senior economist and strategist at Aviva Investors, says yields are likely to keep rising as the fiscal measures boost economic growth. And it says here bond yields hitting 4% would mark the highest level since the global financial crisis in 2008. Gikionikis, his call follows a similar projection by BNP Paribas SA strategist Sam Linton Brown. He says this week that yields may reach as high as 4% by 2028 amid potential rate hikes by the European Central Bank for the second half of the year of next year. So again, we're talking about rate hikes, right? Bond yields going higher, rate hikes potentially coming in the maybe next year. And it says here the strategist is bullish on the euro and sees an increase to 115 on the euro dollar before year end if severe US tariffs can be avoided. It was trading around 108 on 1.085 on Thursday. So ultimately, when we go to the euro dollar, this could actually be a really nice buying opportunity. But again, I am kind of conflicted on this pair. So I'm going to sit out of the euro dollar for now because I think there's much better pairs to kind of trade. Either way, the euro does look like it maybe could go to the 115s being somewhere around these highs, right? 149.50. Yeah, so 150 would be like up at these highs right here, is what the forecast is. But that's, of course, kind of like hoping that the trade tariffs don't get worse. If they get worse, then actually we could see a deeper pullback from the in on the euro dollar as risk off takes hold, and if the dollar is seen as the currency that should be bought during the risk off environment, then in fact we could come all the way down to the 105s. Right, 105s would be where you've got this bit of resistance here, which could turn, to support. So this all depends upon the tariffs really as to where prices may go. But it looks like a lot of institutions are more bullish on the euro. So it does look like the path of least resistance after the tariffs should be more to the long side. Euro yen, and again, prices did kind of bounce off of that area there. Nice uh, area to look for short. Wasn't looking for shorts though on this pair, but if you are, then that was really the opportunity to look for your short trade. If you're looking for a long trade, then prices have come down to this area here, which is a decent demand zone. And when you've got quite a wide area of demand, you can always just place where support and resistance is, and that's where institutions have been buying and selling, right? Pretty much. So that's the area where you've got some support as well as support there, and a bit of support here. So if prices do come down, if you're looking for buys right now, or there. But again, with the yen looking to uh, hike rates, the euro, although a bit bullish on that in a risk-off environment, you would expect really the yen to appreciate um, against the euro. Euro pound again, not really a pair that I'm too interested in at the moment, but I do think they're a bit on the even side when it comes to a little bit monetary policy. And so, if you are looking for sell trades, then I would look for and buying the pound. Then you're looking for a pullback, something like this. If you're looking to buy the euro, at the moment, doesn't look like there's really any levels to buy the euro until prices really fall down there, or you'd have to wait for prices to make a new kind of high, something like this, like a higher low, and then prices pull back into that area, prove that there's demand at a certain price before then going long. But again, not really a pair I'm too interested in. The Aussie dollar, US dollar could actually be a bit more of a sell if prices pull back. Again, in a risk-off environment, you would think that the dollar should be the buy. Also, as well, the Australian dollar in terms of China and tariffs. If China start to escalate the trade war, then that's going to affect the Australian dollar, and then the Australian dollar is likely to continue moving to the downside. Whether it pulls back that high or not, who knows? But ultimately, I think the path of these resistance at the moment is likely to be to the downside. But of course, that's just based on maybe the risk off environment. If sentiment does change, and or agreements do start to happen, and everyone's happy with the trade negotiations, then in fact I do think that the US dollar is likely to be a bit more of a sell, and the commodity currencies are likely to rally. Gold still making all-time highs, right? Again, this is I guess an indication of risk sentiment. Of course, we have pullbacks in a move to the upside. So as long as gold keeps making these higher highs, it does look like prices, it doesn't look like sentiment is still more risk off. So I would say maybe look for a pullback. If you can get a deeper pullback, will be a better price for gold, maybe at the 2.9s. So if anyone who kind of missed out on this move here to the upside, I would say look for a buy there. Of course, you can look for buys here. There is demand there, but I don't like to really kind of buy at highs. But let's see what happens with gold again. Really, direction of travel should continue to be to the upside, and then we have the S&P stop short of this demand zone right here, right? The five round number didn't quite get there, so it's proving that there's a little bit of demand here, right? You can see that there is demand, higher highs being made. What do I know is higher highs being made? Because you've got a move up and a move down and then a move up. That makes higher high, and then you could see prices actually come to the downside. Now, as a rule of thumb, whenever you have central banks on a rate cutting cycle, um, the stock markets indices typically move to the upside, but then you have to also balance that out with the risk sentiment side of things, and whether there are fears about a contraction. But even then, I think once those fears do start to dissipate, then the stock market really should be a buy overall. So this has only been like a 10% like a 10% drop, which isn't, isn't to be, like unexpected really. It's we've had, 10% drops before. This has been about a 10% drop back in, July, August last year. There was a little bit of a drop here. It was about 6%. We've had, what's that, been about 5%, 4% there. Even this drop here was around 5%. So 10%, we've had about 10% drop there. And even from in 2023, there was about a 10% drop again, right? It looked like it was, in the midst of a downtrend, but ultimately, it was only about a 10% drop. So 10% seems like, in the past maybe couple of years, a decent pullback to where you can look for some buy trades. Let's just look at this one as well. This drop here was about, okay, was maybe 16, 17%. So we could even see a little bit more to go on here, right? Could see a bit more of little bit more of a drop, but I think overall, if the economy starts to, stabilize a little bit, and then the Fed are more focused on just getting inflation down to their 2% target, then I think the S&P should be and continue to be a buy. If you are looking for sell trades, of course, then you can look for prices to move up to this area here. Technically, it's actually quite nice. You've got a nice area of support and resistance there. Let me delete that and delete that. Where you've got, support there, then a bit of support there, and then you've got a little bit of resistance underneath. So pull back into the 5-770s, and that would be decent for a sell trade if you want to, if you think that you want to get short on the S&P. So going to the trade updates, and I spoke about this earlier in the pound dollar. And again, just as a reminder, you can go back to last week's analysis. I kind of break it down, and you can see where my stop loss was. And as I said before, it literally stopped me out to the pip. My stop loss was right there, and it took me out overnight. And then actually, the I'd already taken profit on one trade, but these two trades, that one there and that one there, the market order, I got stopped out on. In fact, if I didn't get stopped out here, then this 50% market order would have been a profitable trade. As you can see, prices end up going to the downside, and that would have been a nice profitable trade. I would have had two wins and still been in this market order right here. But it is what it is. Sometimes it happens. And again, as I said before, it was a much smaller positions I was taking on this, because I knew it was a bit of a riskier trade. So it's just a very tiny loss on that one. And again, if I do see prices move to the upside, then I will look to get involved in that again. The new trades I took this week was only the New Zealand yen. I missed the Swiss yen, and I'm going to talk over that as well. That was a trade that, a lot of traders and in the group ended up getting involved in getting profits on taking, well, no, where they took profits on that, but there should be in some decent profits on that trade. So um, looking at the New Zealand yen, why the New Zealand yen? Because ultimately, in a risk-off environment, you want to be a buyer of the yen. Yes, the New Zealand dollar did have some good news in terms of their economy, but ultimately the dominant narrative is about trade tariffs and worries and fears around that. So the Bank of Japan were also a bit on the hawkish side when they had their statement. So that was the statement was on, the interest rate decision. Even though they held it, they were quite hawkish. So my entry was here, ended up getting into two positions. So when prices pulled back, ended up in that position as well, right there, and then took profits on that position, a 1-to-1, and then on this position, which I think I entered around, that was it about there. Prices ended up going, quite a long way. So I ended up though not taking profits down here. I took some profits, 3/4 on a pullback. Reason being is because um, there was some inflation data that ended up coming out, and the inflation data on the surface actually looked a little bit bearish. So when I woke up in the morning and I saw the inflation data come down, I thought I'd take, about three quarters off, 75% off, and leave about 25%. But actually, this was the inflation data was actually seen as actually being quite hawkish and supporting the Bank of Japan's rate hike. So it says here the pace of Japan's consumer inflation was a little stronger than expected, even as the resumption of government energy subsidies slowed price gains, inflation backing the case for the Bank of Japan to stay on a gradual rate hike path. So, it's really about the data supporting or not supporting rate hikes. And so, good thing I left obviously some on the table still, so I'm still in this, only 0.25%, but now I'm looking to kind of just trail my stop and try and hold this for as long as I possibly can. So let's see what happens with that trade. This trade now was the one that I ended up missing. In fact, it was the day of FOMC, and I was in a conversation with someone, totally forgot about my entry. And when I saw it, prices were actually down here. So it was around here, right? So I was thinking to myself, all right, what I'll do is I really wanted an entry at the 170, 4.8, somewhere around there. So what I did was I set a buy pending order, thinking that prices could move to the upside, because this was the day of FOMC. Um when FOMC does come out, you can get volatile price. So I thought I want a better entry, and what I'll do is I'll just place the sell pending orders, here and here, and then hopefully our prices will just come back, which they typically do, normally do. They will bounce around a little bit, and especially during FOMC when there's a lot of volatility, and then hopefully I'll get into one position, right? And as I said, it typically does do that, but in this occasion, right, it didn't. It actually went to the just literally continue going to the downside, right? There we are. Just literally went to the downside. So I never got my entry. So I think we were all waiting for this in the group. Well, I definitely was talking about this, and all week. And then, basically on the day, I end up missing out on my entry. But it happens, it is what it is. It's just one trade in the lifetime of trades I'm going to be taking. So ultimately, the analysis was correct, and that's really one of the main things, is that, as long as you're consistent with your analysis, if you miss a trade, doesn't matter, because you're going to get another trade at some point, and if you're consistent with your analysis and fundamentals, then you'll make money then, right? Like I said, it's a little bit frustrating, but ultimately, what matters as well is that the group, the mentoring group, saw the same trade, and those guys made some money. So even if I didn't make any money on this, them guys did, and so that is some something nice as well. So yeah, that's basically it for the week. I hope you enjoyed the analysis, found it useful, and I'll see you all next week. Take care and all the best.